Good afternoon, everyone. The purpose of this presentation is to review the use of data and predictive analytics driven by information technology and actuarial science in the Canadian property and casualty industry. The research behind the presentation focuses on industry results from 1975 to current day, but keenly focuses from the period from 2003 to present. We also throw in some blasts from the past for those who love history or seek a greater contextual perspective. And after the presentation, we welcome questions and comments and hope we have inspired you to drive continued thought leadership through pertaining to data analytics, and emerging technologies. The combined ratio has always been the benchmark by which our industry has measured results and is probably one of the most important business ratios in our industry. The insurance industry has weathered several hard and soft market cycles and has reacted accordingly to periods of underwriting profit and loss. As you will see from our graph, since 1975, the industry has predominantly operated well above the 100% combined ratio. This highlights that historically overall, business results were often propped up by investment income. The graph further illustrates something very unique, and that is what has happened in the last decade from 2003 to present day, where we see the industry currently well below, in most cases, the 100-line ratio. We believe that there's something unique has happened during this time, and further we believe that one of the biggest fuelers driving this is the use of data, predictive analytics, and new technologies allowing actuarial science to drive data and data intelligence at a greater pace than ever before. Our purpose today is to understand what changed this and how this change is redefining the competitive nature of the insurance industry. Now, if we look at this next graph, what we've done is we've now looked at results, and again, you see this big spike from 2003 onward pertaining to net profitability and loss. But for interest, we also have looked at the interest rate cycle during this same period. Another big driver, we believe, that started in 2003 was the recognition by the Canadian insurance industry that investment income is not going to be the way in which profits will be driven. As you see, as we've reached since the 2008 financial crisis, interest rates have been flat, and if ever more important for the industry to drive underwriting profitability, thus creating a new adage within our industry that 95 is the old 100. Simply, profitability must be reached, and it has to be through underwriting profits. You'll notice that at the time coming out of the last hard market cycle, it's very interesting to know that our industry was so consumed before the last hard market cycle in 2000 with development work on the year 2000 project that all resources and capital were fueled on making sure that we did not have business interruption. But as we came out the back end of that cycle, investments were immediately deployed into new technologies, including ramp up of actuarial science and data analytic platforms to be able to digest large amounts of information and to make correct decisioning. We also saw a move where the industry began to segment its books greater than it ever has before. If you look at this from a pure operating expense line over the years, you can see that there is increased expenses, which I argue some of it is just the cost of doing business, but some of it is investment into IT platforms. If you look at insurance claims incurred, again, the lines kind of trend somewhat homogeneously, but this is an interesting line where you see a spike of net premiums earned. And when you harmonize this line, you can essentially see the real trend of, well, whereas before the blue line trends below the industry claims experience, you start to see that from 2003 onward, we have been ahead of the payouts on claims. And again, we argue that you could say that there's been some years where we haven't had as much weather-related events, but entered 2013, and that theory's behind us. But essentially, analytics and market segmentation and individual risk assessment is being deployed by the industry at a more rapid rate, and it's showing results. Now, we know that data is a key competitive differentiator in today's competitive market. For certain, if you're going to utilize predictive analytics, you're going to require large amounts of data, advanced analytic expertise, and modern systems to pull information in a meaningful and proliferating way. Standard protocol is critical and is a major component of the equation, and it must be governed. So let's quickly review how our industry has historically gathered data and utilized it in the underwriting process. And let's go back through time. Lloyd's Coffee House was opened by Edward Lloyd in 1688, and it became a place to discuss risk and obtain information for cargo vessels and insurance. While underwriting risk 300 years ago was far less of a science and more about gut decisions, arguably this environment formed the early processes around loss control, data gathering for underwriting purposes. Seaworthy vessels became subject to inspection from ship to cargo to crew members, leading to improved risk decisioning, and those that didn't make it obviously suffered issues where we had boats sinking. Now, you can't always prevent risk. You can't always prevent a peril from occurring, but for certain, the gathering of information, back then and still to this day, I would argue that part of this process was relationship building with the captain and with the crew and an understanding of what that cargo was. In fact, ironically, the word shit comes from making sure that manure was stored high in transit, essence of the words, because manure was a combustible that often was causing problems if it was stored on lower deck. So we have quite a history here. You use the S word and everybody laughs. In 1871, the Great Chicago Fire occurred on October 8th, starting at a small barn in a central business district owned by Patrick O'Leary. So we owe Patrick a good old-fashioned St. Patrick's Day toast, I assume. It was stated that the origin of the fire was caused from a cow kicking over a lantern, and I don't want to be privy to bad faith. However, it was later speculated that men were gambling in the barn and had accidentally knocked the lamp over. Let's focus on the data for a minute surrounding this fire. The fire spread was aided by the use of wood construction as the predominant building material, and a drought had happened earlier that spring. And there were strong winds coming from the southwest the night of the fire. The initial response to the fire was quick, but due to an error by a watchman named Matthias Schaefer, the firefighters were sent to the wrong location, allowing the fire to grow unchecked. Isn't it interesting that construction variables, location, weather, and response of fire services are still key predictables in today's world? Great fires also happened in 1872 in Boston and 1873 in Portland. The first Great Fire of Toronto occurred in 1849 on April 7th, and coincidentally, the second Great Fire in the city occurred on April 9th, 1904. And in fact, as I looked at the Canadian loss on early fires that led to standardization in our industry, coincidentally, they all happened between April and October, 5 of 6 fires beginning in April, which is, again, from a data analytics perspective, I'm sure I'd be looking at that to try to track to see what was occurring there. Other major cities experienced massive losses between 1852 and 1900. These include Montreal, Halifax, Quebec, Vancouver, and onward. The Great Fire that happened in Toronto in this very city burned approximately 104 locations to the ground. It set up a claim in 1904 cost of $10,350,000. 5,000 people in a population of 200,000 people were without income as a result of that fire, but it basically destroyed on our southern boundary from the Esplanade to the north up on Adelaide Street to York Street on our western boundary to Yonge Street. So think about that whole area being completely wiped out by fire. And what did that mean, and how were we going to act about it? After the fires in the US, insurers spurned cities to reform their standards and enhance its firefighting force. In 1883, Canada followed suit, forming the Canadian Fire Underwriting Association to create standard fire rates, protocols for loss control, risk assessments, and risk rates for commercial and residential properties. The CUA eventually became the Insurers Advisory Organization, effectively acting as a central repository of manual paper information for the industry and to produce guidelines on how the industry should manage its data and should assess risks. Opta is the heritage business that came from that background dating back to the 1800s. And one of the things we were able to do was to catalog all of that paper information and digitize it into electronic format to help insurance companies be more profitable through their use in their building of predictive analytics. These fire maps that you see, which many of you will remember, have now been geocoded and overlaid perfectly on geoimagery of Google, so that a person can look back, like I've shown you a look back in time. We can look back at 1910 or 20 and see what occupation was on these fire maps and if they were producing hazard materials or if there's any risk pertaining to environmental damages. Again, a great leap forward. But what I argue is that we always gathered data. We have fought for consistency of data for a long period of time. Now we have the systems and the technology finally to utilize information at a much more rapid pace. So another aspect of collecting data became catastrophic losses over the last 100 years. What the events were and how we impacted the industry, and an assessment always on, is there anything that could be done better to mitigate risk? At the same time, you see the industry being able to move in its ability to utilize data from what once was paper, moving towards catalog trays, as you see here. Again, some people remember access to old computer systems, such as Honeywell systems that basically had virtually no data or power like we have currently on a smartphone. That would take a full room of old computer processing devices to be able to deliver. When I first started servicing the insurance industry and through predominantly information, this is not unlike what data centers looked like when I was in servicing them. There was not a lot of IT protocol. I remember installing programs onto companies' networks using 3.5 floppy disks, often unattended by the CIO or anybody in the technology departments, because it was predominantly driven on a business relation at that time. Interesting enough, we used to also transmit underwriting information predominantly through modem technology. So phone lines would be dialed to transmit information, predominantly that would call a bulletin board to gather claims history information, motor vehicle records, and such to bring back to a customer. But those lines were very, very limited. We could not drive the amount of bandwidth that's necessary to drive analytical systems in today's world. And really that was a prevention. And ladies and gentlemen, those systems were alive into the late 90s. We really didn't get into web architecture until, web services architecture until the early 2000s, after we came out the back end of the last hard market cycle. And we were able to do two things: divert the spend into data and data analytics, and hire a strong bench of actuarial teams and analytical systems simultaneously. And it's made a difference. Today, if you look at the types of technology that is out there, we have iPads, we have smartphones, we have web services architecture that's capable of contacting several data points in milliseconds and transforming that information back to carriers in real time, feeding analytical models and feeding decisioning at a rate that's never occurred before. We're also at a time where our industry is replacing their back-end systems. So at a time when we talk about new technologies such as telematics, and we talk about risk assessment using data analytics, we're also at the same time refueling our own back offices with modern day technologies and policy management systems that are capable of turning this even faster and forward at a greater pace. Now, where are we in present day? So this is the Moneyball point. Maureen Tomlinson, who's in our room, who works with Opta, wrote a paper recently comparing Billy Beane's use of data analytics for his purposes in baseball to some work that the industry can do utilizing data analytics, and some work that Opta has done using data analytics. But I think this is where the real money question shows up. Opta has run a study to look at industry insurers that are currently using data and modern technology and data analytics and actuarial science at a stronger degree than some on the lower scale who are not. And through our analysis, those that are using this technology and the analytics are currently outperforming their counterparts by roughly 8%. Now, if we are going to stay below that 100-line marker, this is something that's undeniably is a tool that is not something that can be overlooked. To be able to get into this competitive race, because we've seen it happen in the United States, we've seen the analytics used strongly in Europe. Canada's adopting it. You need the sophistication to be able to manage data, but you need data. And what's interesting as you build models, and Opta has been building our own predictive models, is that you'll find that often attributes that you did not know had strong correlation to results of claims frequency and severity absolutely do. Often, sometimes logical underwriting thinking can be found to be inverse in models that are built out by actuarial minds using complicated data sets. So I think that speaks for itself, and that's the best I can do on my Moneyball scenario. So if we go back and we look again at this ratio, what's also happening here is we're seeing market segmentation occur. So it's not just about my property in a postal code or a boundary area, it's my property on a longitude and latitude. And that's how finite underwriting is becoming, whether it be a commercial building and its location and its past claims history, and is it situated to an area of poor infrastructure, and is it situated to an area that's more prone to sewer backup, is it situated to more prone to fires, is it properly fire protected? All of those questions and thousands more can be answered instantaneously on a longitude and latitude basis. Telematics obviously is driving a change in our industry on automobile. The usage of driving, and I was intrigued by the last presentation to see how far and how fast this is happening, but people sharing vehicles and people sharing and being engaged on how they drove yesterday and today versus a rate classification that used to occur in traditional underwriting. Now, as we look to the future, I can't tell you if this line is going to drop or continue to drop, because I'm not aware and I can't predict that. And I also can't predict if it's going to stay straight or if we're going to see ourselves rebound once again above the 100 marker. But I can tell you with great certainty that weather has remained a challenge in our industry, and I do not envision that we're in for any real change, because there seems to be unpredicted wind, hail, flooding that is occurring at a rate that it's logical to assume that that will continue to move forward. And again, we can't tell you when these storms will occur, but we can tell, and you're looking at your own books and reviewing this as insurers, as to how accumulated you are in areas, and if a result happened, what would the impact be economically to your bottom line. Lots of discussion right now about cyber attacks. As the industry stores and gathers more data to drive out its analytical solutions, we ourselves are more vulnerable to cyber attacks and the threat of a cyber attack. And businesses have to protect themselves against this for liability purposes and business interruption purposes, providing a great opportunity for insurers to provide coverage, providing a challenge and an opportunity for IT solution providers to make sure that security is always at the forefront. And when we have nation states attacking each other through cyber attacks, it's a very interesting time in today's modern history. Also, I've attended insurance discussions where we talk about the threat of our reliance on modern technology, and could those technologies therefore be disrupted through solar flares, solar storms, or activity in space that could somehow knock out satellites, knock out our ability to communicate. I can't predict that, but nor could any of us predict the events this summer, where in Canada, property losses are at an all-time high. Nobody could have predicted that the Bow River, while it might have flooded, would flood that fast and that furious in one day. And whether or not you had great data on infrastructure information, or you had thoroughly understood how accumulated you were next to these areas or in High River, it would have been very difficult to predict what was about to occur. And then to follow that up with losses in Toronto. Having insight to some aspects of independent adjusting, most independent adjusting firms were very quiet for 18 months leading up to these storms, and the events from that point onward have fueled a lot of claims for independent adjusters as well as in-house adjusters. But when we see a GO train and people having to be evacuated from the second floor, nobody could really envision what or how that could happen, or neighborhoods being flooded. I can tell you that I personally believe that technology for certain helps us to assess where we are from a risk-by-risk basis. It can help us understand what areas of our book are profitable and which areas are not. It can help us understand from a marketing perspective where we want to market and target our consumer base, because we know it'll drive stronger profitability, and which areas of our books we should look at tweaking because perhaps we're over accumulated, or perhaps we're not charging enough in that certain area and we're attracting business that's more prone to poor results. This is not to redline or segment the business group. This is to provide opportunity for insurers. There's a debate right now, should we cover floodplain insurance? Undoubtedly we will. And there is gray market insurance right now for residential properties and commercial properties that exist for various different marketplaces. And I can predict that's going to continue. I could also suggest to you that those in the room that are not currently using predictive analytics to the same degree as your competitors, that I would encourage you to relook at that, because the performance of 8 points versus 8 points to above the line is just something that's going to make it very difficult to compete long term. Smaller insurers will have to find the ability to purchase and procure data to help them drive their own analytical models and utilize either higher internal resources or utilizing other firms to help them achieve their own objectives in this area. And I personally believe if there was ever a time to look at property, it's right now, because the regulatory changes that are happening, they're impacting you in automobile, is somewhat beyond your capabilities. I'm a firm believer in the use of telematics, and I applaud that use. But with the record changes of losses on the property books across Canada last year, I personally believe if there was ever a time to use predictive analytics to assess where you should be and how you're accumulated in these areas, that time is now. I'd like to personally thank everybody for having me here to talk today. And I'd like to open it up to any questions that you may have.
Sure, thanks. Do you see that being a big change from what you're talking about?
Yeah, absolutely. It would make a tremendous change in the way that we look at risk. The trick will be we're still a bit behind on being able to gather access to that information currently. Not that I believe that that's something that will be long term. But if there was ever, I think the other encouraging sign there, Ron, is the fact that if consumers are willing to share a snapshot of how they drive and they're getting a discounted insurance rate perhaps as a result of that, that same consumer is probably willing to share information on their home, and it will definitely have an impact. And I believe it's coming. We're not there yet, but I believe it is coming. I can tell you what's interesting on the property side is traditional models. A lot of people in the room have done work on automobile, and I understand all the good reasons for that. What we found on the property side is, again, back to the inverseness of the models. It's a totally different, the data and the strong points that add strong signal to predictive models from our experience are ones that most often wouldn't be considered from an automobile perspective. Do you believe that predictive analytics are actually as powerful as I suggest they are? I see a lot of people nodding. To me, this was, in the markets that we researched before making our own personal business decisions to venture into these areas, it was just astounding on the differentiator and what this did to, in the North American and like in the United States marketplace when predictive analytics were deployed, in the UK and places as in Europe where analytics were deployed. You know, I remember back in 1997 when I first started at the Insurers Advisory Organization. At that time, we had an ability to distribute credit information for insurance purposes through an agreement that we had with a large credit supplier. And I remember in some occasions almost getting thrown out of the meeting when we would discuss or just throw out the topic of credit. It was so controversial. I'm not saying that it's not controversial still, but the industry's mind has come a long, long way since it was a topic that was often, the books would shut and we would move on to another topic because it wasn't something that people wanted to discuss. I think that everybody's, sees the power of credit, whether you believe in its use or not. But there are so many other data attributes out there that drive good decisioning that are outside of credit. And you could argue someday that what other data sets are going to be out there that we haven't even uncovered yet. As Ron mentioned, information on homes that are, and what time does your thermostat click on? How hot do you keep your house? What time do you come home? Do you have a burglary alarm? All of those things, what would that do? And what future decisioning will that make? Thank you very much, everyone.